Want to know what the interest rates are in Rhode Island today? Well, in today's video, my team and I are going to talk extensively about what they are so that you can make a better buying decision. So if this is your first time to the channel and you want to know everything there is about living in Rhode Island, subscribe below, tap the bell for notifications so you can be the first to learn about the current market here in Rhode Island. My name is Devin, and my team and I, we get calls and texts every single day from people just like you looking to make their move to Rhode Island, and we absolutely love it. So whether you're moving in 9 days or 90 days, give us a call, shoot us a text, or send us an email so we can help you make a smooth transition here to the Ocean State. So the big question is, what are the interest rates in Rhode Island? So I have with me Nate Nary from Movement Mortgage. He's a very popular lender here in the state of Rhode Island. So that's the big question, Nate, is what are the interest rates right now in Rhode Island?
So Devin, that's a great question.
Yeah.
They do vary quite a bit. It all depends obviously on product and type of
Sure.
transaction you're doing. So if it's a purchase, it could either be as for an investment property, it could be a second home, or obviously a primary home. Also, it could be a first-time home buyer, putting down little to no money, or you could be, kind of upgrading to your dream home and putting down a significant amount of money, or doing like a jumbo mortgage.
Yeah.
So interest rates obviously there's a pretty wide range at the moment.
Yeah.
They are high, compared to what we've seen in the last 10 years. I mean, everybody knows that, right?
Yeah.
But
it's the elephant in the room.
Exactly. But with that also comes, I think, some positive things for buyers. I'm sure as you're seeing as a realtor.
Sure.
You're starting to see some price negotiations. You're starting to see it where, you don't have to go 20,000, 50,000 above appraised value.
Yeah, just to get your foot in the door.
With the appraisal gap funds, you're starting to see those finally go away. You're finally starting to see some seller credits come back, which can be used a lot of ways to offset those high interest rates.
Sure.
And also kind of give a happy median for both the seller and the buyer. Kind of getting back to a normal market.
Yeah.
That's what I'm saying.
What are some of the expectations, because there are different loan products for what you're buying. So if you're not aware, if you're buying a first-time home, or if you're buying a second home or a jumbo mortgage, why don't we focus on for now for the viewers, what is like an FHA or conventional rate look like right now for a home that you're moving in before we go to investment or second home?
Good question. So for FHA primary purchase, like little money down, that's typically what you're looking for as a first-time home buyer, for example, where an FHA loan is really kind of targeted towards.
Yeah.
Those interest rates are still pretty good. I mean, I say good comparatively to like a conventional
to what it was
rate.
6 months ago.
Exactly.
Yeah.
So you're still looking at mid to low sixes, I'd say on average.
Okay.
Obviously with a fluctuation in the market, which there is a lot of fluctuation right now.
Yeah.
Sometimes you could touch the high fives, and then sometimes just touching the high sixes.
Because it changes daily.
Exactly.
Most people don't even realize that those rates are changing daily.
Correct. Yeah. So it's all based on the mortgage-backed securities.
Yeah.
So as those bond prices, change, so do interest rates. So on a day like today, when you're looking at bond yields, they've already changed twice. Just to give you an idea.
That's a big factor. So you're getting a lot of phone calls like, "Hey, listen, what's the rate today?"
Exactly. So you always want to touch base with your lender. So if you're somebody that you have a pre-approved letter, before you put an offer in, just make sure you reach out to your lender to make sure that payment's hasn't changed. And if it has,
you go from $2,000 a month to $500 a month, and all of a sudden the home is no longer looking as good as it did.
Exactly. So make sure you have your numbers right. You know what I mean? Because the last thing you want to do is go get an offer accepted. You're super excited, and that payment changed, and then
you're not excited.
You're trying to work it out at the last.
Now you're trying to get out of the deal. Now you're like, what contingencies can we use to get out of the deal?
Yeah, that's a lot. Nobody wants that. You know what I mean?
What is the rate lock right now? Like if I was a buyer in the marketplace, and this is good for the viewers, if I'm a buyer in the marketplace and I'm buying an FHA or a conventional home, and I say, "Hey Nate, lock me in," what does that look like? Is it 90 days?
So that's up to you. It's obviously based on the purchase, where you're seeing some difficulty with that is a lot of times these contracts are coming in, I'm sure as you know, where it's seller to find suitable housing, right?
Yeah.
Now that's a moving target. So with that, you always want to make sure you kind of lock a little bit beyond that anticipated close date to make sure you're protected as a buyer. So you can lock in as little as 15 days, 30 days, all the way to, we have locks that are 360 days.
But it's costing the buyer to do that.
It is costing the buyer to do that.
Go into a little detail with that, because I think a lot of people don't understand the advantage of being able to lock in a rate and what that cost looks like for them. So if somebody wanted to go maybe an exorbitantly over their purchase time frame, what kind of costs are they looking at to do that?
It is going to depend a little bit on the product as well for that, because sometimes with FHA you can have the same lock period for a 30 days, you do a 60. If you go beyond the lock period, like lock extensions, I think that's kind of where you're getting at.
Yeah.
Is typically you're looking at about a quarter of a basis point, 25 basis points, I should say. I apologize. For every 14 days you need an extension on.
Interesting.
So we can kind of go over basis points separately because that's kind of different calculation.
Yeah, there's a lot of calculations when you're getting.
But so that's not the interest rate. It's just 25 basis points. So let's say, for example, a $100,000 loan. That's $250.
Yeah. And it's worth it when you're in a market like this. Now, Nate mentioned something earlier called suitable housing, and that may be a term most people are not familiar with. But when it says seller to find suitable housing, it means that seller, even though they've accepted your contract, the deal's not done because they have to go out and now find something that works for them. So that domino effect, it makes the deal extremely difficult because as a buyer, you found a property that you like, you love it, but there's still that contingency of the seller saying, hey, I may not do this deal.
Exactly.
Exactly. And that's what Nate means by that kind of shooting target is like still up in the air. You can make it through inspections, you can make it through mortgage contingency. Until that's waived, you may be out of luck.
Yep.
Right. So that can be very emotional for buyers out there, especially if it's their dream home.
Yes.
So that gives us a really good understanding of kind of the conventional product and what people are looking at. What does second home look like right now?
So second home and investment properties, there are a lot of adders that just were placed this past year from Fannie Mae and Freddie Mac, the GSEs.
Yep.
Where it's, I don't want to say discourage, financing for second home and investment properties, but obviously with an inventory shortage, they want to try to make sure the people that need a home as a primary residence have an advantage. So the interest rates are significantly lower for a primary residence as it is for a second home or investment property. Now you jump into the jumbo sector, different story. You still have good rates for a second home, for example.
What do the rates look like for a second home? And I know they're changing every day.
Yeah.
But what does a second home product rate look like right now, and what does a jumbo rate product look like right now? Much different from 6 months, 8 months ago.
Yes. So to make it easy, I guess you're looking at about I'd say a 2 to 3 percentage point difference between a conventional second home and a jumbo second home.
Wow.
Obviously, those type of products, they're much more subjective to credit score and overall buyer profile.
Income, money
exactly.
available.
So the credit score, if you're looking at a difference of a 740 or a 700, you're looking at a drastically different interest rate for a second home on a jumbo.
Yeah.
Whereas like for FHA or conventional, those type of loans, they're not. It's not as big of a factor. You're not going to have so much. You're not going to see the separation.
Yeah.
If that makes sense.
Do you think a lot of the times they raise the interest rates on second homes so much because those are typically the type of homes that typically get foreclosed on when the market shifts?
Oh, there's definitely risk involved in those decisions, I'm sure.
Yeah,
and you got to remember too, like the last 2 years, there was more mortgage volume than there's ever been than we've ever experienced. You know what I mean? They've kind of quadrupled what they typically do, actually more than that, 2 years consecutively. So I mean, you got to remember that they're kind of overly leveraged.
Yeah.
And they're trying to kind of shrink that down a little bit, which this market is doing, obviously. The refinances have been pretty much put aside. But it's also kind of giving that advantage to people looking for their primary home, especially the first-time home buyers. So
because
there is positives.
Because I was interested in the Florida market for a second home, but I mean, right now the interest rates are so high that you're like, it does pull you back and give that opportunity for the people that need to buy. So that makes a lot of sense. What have you seen on the investment side of products and the interest rates?
So they haven't really changed too much. I mean, the interest rates, there were more adders is what they call it. So so you're looking at more of a separation than you had before between like a primary home compared to like an investment property for interest rates. But they're very similar now to second homes. I mean, second homes you really saw that's the big change was interest rate adders being tacked onto the second homes, not so much the investment properties. And the good thing about investment properties, you do have a lot of different options there.
Yeah. Depending on the size of the investment vehicle, right?
Exactly.
I mean, you have 2 families, 3 families, 4 families, and then obviously 5 units or above is commercial.
Yes.
So that makes a lot of sense.
Yeah. So you see a lot of variation there.
Yeah. Interesting. Well, one thing that's interesting that I think a lot of people don't take into consideration, because all the time people are asking and reaching out, is now the time to buy? Is now the time? What can I do to get in better position? And I think credit score plays a huge factor on your interest rate.
100%.
What can people do to, what have you seen? Like, if somebody approaches you and says, hey, my credit score is 650 or my credit score is 600, what recommendations can you give to buyers out there when their credit scores may not be as good as they think they can get them? I mean, what kind of recommendations do you give to them?
So that can vary quite a bit as well.
Yeah.
The one thing I would say is like being proactive and kind of getting that application in with your lender as soon as possible so they can give you the proper advice, because the more time you have, the better, easier it's going to be to get your score where you want it to be, to get that best interest rate and be approved for that type of that price point that you want. So I mean, there's a lot of different ways. Obviously, you have 2 different credit reports that could be two totally different explanations of how to bump that score up. Of all things considered, if everything's pretty good, there's no bankruptcies or anything of that nature. A lot of times, just simply paying down your credit card balances and keeping them at
improving your utilization.
20%. Exactly.
Yeah, because a lot of people's utilization is so high, they don't even realize that it is a game.
Exactly.
Right? And when you're maxing your credit card out and not paying it off monthly, you're showing to that bank or the credit card company that, hey, I need to use debt to handle my bills.
Correct. Yeah. So that percentage of debt usage, like you said, is a big factor in driving your credit score. Probably the biggest if you're, especially in the higher tier of credit scores.
Yeah, interesting. And where do you kind of see that tipping point? Because you don't want to discourage somebody from buying, but you also, as people that look to us as the experts and people that they want to trust, I mean, what kind of credit score do you see where it does really help them, like going from 650 to 700 or 580 to 650? Where is the biggest marginal jump for having a good credit score?
So
on the interest rate.
Yeah, so I would say 720 and plus is really where you ideally would like to be. You know what I mean? Because you really open up all your doors at that point. Every 20 points, it kind of it allows you to have better pricing. If that makes sense.
Which ultimately affects your payment, which ultimately affects the size of the house you can buy.
Oh, yeah. And what you get qualified up to, because you're allowed to have a little bit more flexibility on the ratios the higher your score is as well. So, obviously, the higher you can get your score, the better. That goes without really having to be
said. In golf, it's not the same.
Exactly, just the opposite of golf.
You want to go lower.
Exactly. But yeah, I mean, the thing is, obviously, the higher you can get the score, the better. Ideally, you want to be above 720. That kind of allows
that really starts to open the door.
Especially if you're looking for the first-time homebuyer programs. 100% financing options, stuff like that. The higher, the better. 680 is really where you want to be above for anything in that.
That's kind of like
realm.
the minimum foundation.
That's really the minimum where you want to be, and that's going to be really highly scrutinized. It's going to be tough to get an approval. So, if you're not there, not a big deal. Just work on getting that credit up, and there's a lot of tips and tricks we can help you out with that. And obviously, we do a full credit analysis. We can tell you exactly what to do, how to work out your credit, give you a timeline on where to get your score up to. So I mean, I'd be happy to work with people that I do that on a daily basis. Most lenders are very good there, so reach out to your lender for that.
Outside of the utilization, what are some other things that you really see impact the credit score for the interest rate? Old bills?
Old collections, charge-offs, stuff like that. I mean, and it's not always best to pay them off, as crazy as that sounds.
Yeah.
So, I mean, that's really, you really want to talk to somebody that's a professional and can really kind of guide you in the right direction and be a consultant and make sure, hey, listen, I know you have this money to pay this off, but it's not going to get your score where you want it to.
It's
better
ironic
to pay down this credit card that you have in good standing.
Yeah, it's ironic. It's like if somebody falls behind on their mortgage, you would think, in theory, hey, if you have the money to catch it up, just pay it up. But it actually goes against you. You should pay maybe 1 month and stagger it, because it just, I don't know why. I mean, why is that? I truly don't know. Just the game they play?
Yeah, I mean, that's a whole different conversation. You could have hours for that.
Yeah.
I mean, the one thing that's always important is your installment debts. Your mortgage, you do always want to make sure that's paid on time. That's a big factor. That's something, especially if you're going to buy another house, you really need to have a clean 12-month history, meaning no lates beyond 30 days. That's a big factor. Other installment debts, car payments, student loans, you want to be in good standing on those, because a lot of times, if you're not, you really can't fix that. Now, if it's gone past that point where you're no longer, behind, you're
caught up, you're on time,
you're in collection or charge off, that's where the conversation goes. Does it make sense to pay these things off? You know what I mean? A lot of time the answer, believe it or not, is going to be no. So there is better ways to allocate your money.
Yeah.
So just make sure you talk to a professional before doing anything, because that common sense approach where I'll pay this off, I'll get a clean slate, isn't always the best thing, believe it or not.
Yeah, interesting. One thing that I'd like to hear your take on it is, with the interest rates being where they're at, right? A lot of buyers have started to pull back. What are some creative things that you've seen people been able to do, like maybe having the seller buy down the interest rate, or seller concessions? What are some of the things you've seen buyers doing to help offset maybe their hesitation about buying at a higher interest rate?
Great question. So I think here's the win way to look at it is this is a good time for buyers. You know what I mean? You're finally seeing prices level out and come down a little bit. You're finally starting to see where sellers are negotiating those seller credits where you really didn't have that.
No, 8 months ago they said,
that was like, forget about it.
Yeah, sellers were walking, with their shoulders high. They were excited. They put their house on the market, and all of a sudden it's gone in one day.
Exactly. So I guess to answer that question properly, using those seller credits to your advantage, like a 2-1 buy down, for example, is a great win-win for both.
Can you explain a 2-1 buy down? Because a lot of that can get confusing for buyers.
And it's easy to be confusing on that. So a 2-1 buy down, basically what that is you're taking that seller credit. So let's just kind of make numbers simple here. Let's say the seller credit is
10 grand.
10 grand. That makes it easy. You can take that seller credit to put towards a 2-1 buy down. So let's say interest rates today are 7%. Okay. All right. You'd be locked in at a fixed rate at 7%. But for the first year, you're taking money from that seller concession.
Yep.
Is going into the buyer's escrow account. So it's not a closing cost. You're not paying points. That's a big misconception there. Yeah. It's going into your escrow account where it's subsidizing your payment for the first year. So basically, first 2 years. So for the first year, it's subsidized by the equivalent of 2% on the interest rate. So you're effectively paying a rate of 5% for the first year.
Yep.
And then it goes up to 6% for the second year. Now, the cool thing about a 2-1 buy down is, if you look at most of the analysts out there, and if you read the newspaper, the Wall Street Journal, and whatnot, a lot of people widely anticipate interest rates to fall over the next year to 2 years.
Yes. Tops, right? So you go in with that, and then you refi.
Exactly. But the nice part about a 2-1 buy down is that money is going into an escrow account. So let's say let's make numbers easy. Let's say it's a $500 difference per month between a 7% rate to the 5% rate. So out of that 10 grand, you're getting $500 that goes to your payment every month to subsidize your payment by that $500. Now, let's say if you refinance in 6 months, you get all that money that you haven't used back.
Oh, interesting.
So
it truly is an escrow account.
Exactly. So it's not you. It's like when you pay points, you're not getting that money back.
No.
And the thing is, if let's say you do an ARM, or if you're buying down the rate by a point, it's probably going to cost you 2 points to get down to a 6% if the rates are 7%. On average, you know what I mean? Because it's usually about a half a point per point.
Yeah.
So instead of not being able to recoup that cost, because it would take you about at least 3 years or so to recoup that on average.
Yeah.
If you refinance, you get all the unused money back, and it goes to the principal of the mortgage. So the beauty of it is you're getting all that money back. It gets applied to the principal. You're not out any money. And typically when interest rates go down, values go up. The appreciation comes back. So it's really a win-win for the buyer.
Yeah, what would you say to buyers out there that have that objection? The interest rates are high. I'm going to hold back. I kind of know what I'm thinking of. I would say is when is a good time to buy then? If the prices are high and the interest rates are low and you're holding back, and if the interest rates are high and the prices are low and you're holding back, when do you buy?
Exactly right.
Right. So how do you handle that objection, or how would you, with integrity, guide somebody that says, "Hey, I want to hold back"? The interest rates are too high.
I think the conversation, you know what I mean? I think, I like to always be a consultant. You know what I mean? I provide the people with the knowledge that I have so they can make a decision that makes sense for them, you know? So I guess what you're hearing a lot now, or what I get a lot from first-time home buyers, I want to wait for the interest rates to come back down. Okay. When the interest rates come back down, this little dip in home values is going to change. It's probably going to go back up, typically how it works. Yeah. So the nice part about the 2-1 buy down, for example, is they are getting that interest rate that's lower for the first year. And with their assumption that the rates are going to come down in a year or 2 years, I do agree with you on that. But you refinance at that point, lock yourself in at the lower interest rate, you get the unused portion of that escrow account back to pay down the principal of the mortgage. So it's really a win-win for the buyer.
And now you're into that asset rather than renting over the next 2 or 3 years.
Correct.
Renting, I own a few properties.
That's 100% interest.
That's 100% interest, but I've increased the rents because the demand for rentals is so high due to the interest rates. So the money's going out either way. Correct. If rent's a little lower, it's a little lower, but that's literally taking the money and throwing it out the window, essentially.
Yeah, you get nothing back on it.
You get nothing back.
No tax deduction, no appreciation. Yeah. At least even if the market's flat, you're paying down some principal. Yeah. And you get the tax deduction, which overall helps you out. Yeah.
What have you seen, or because nobody can predict the future, right? That's people ask, what do you think is going to happen in 2 years? You don't know, but what have maybe you heard in your environment or in your industry of what's going to happen over the next 6 months, and then where we think we're going to be 2 years from now? So are interest rates going to continue to increase? And then I think we'll see a decrease in a year or 2.5. And again, we're not making any predictions. We're just having a conversation.
Exactly. I mean, nobody can predict the future. Nobody has a crystal ball. I certainly don't.
Yeah.
But, to answer that question based on what I'm hearing and, typically, how I would imagine it would work out is I do think interest rates are going to stay the same or go higher throughout the end of the year.
What do you think they top out at?
I think we're close to it, to be honest with you. I couldn't foresee it going much higher, and if I do, it's going to be like a sharp spike. I hope it come back down. I really just don't know how the economy can handle it, at a sustained period. But I do think interest rates where they're at right now, they're not going to change between now and next month, for example. I think you are going to see them in this range at least until the end of December. Yep. Maybe January, February, you'll start to see some leveling out and pullback. The 75 basis point hike is already priced into interest rates today. So when the Fed hikes the rates next week by the 75 basis point, the market already has that.
They've already adapted to it.
Yeah, it fixed in. So that's not going to have any impact on interest rates. They're also kind of pricing another 50 basis point hike come the next Fed meeting. So as far as the rates go, I mean, I don't think they're going to change too much compared to where they are now, but I don't think they're going to go down. Where they could go down is based on what the Fed says in those meetings for what's going to happen in the future.
So it's like you're always trying to predict. What did he say? Let's rewind that back.
The more they say that like they might slow down on the rate increases or they'll level them out, they're like if they ever say that they're going to reduce them, that obviously would drive interest rates lower. But for the foreseeable future, let's say next 3 months, 4 months, I think we're going to kind of be
right where we're at.
Yeah.
And then hopefully things begin to kind of readjust here over the next.
There's a lot of predictions where people think it's going to be late spring, early summer. We're going to see rates come back down to that 5 range, low 5 range, hopefully. Yeah. But again,
and I think we got so used to the interest rates being 2.5, 2.6, 2.7 that when you're having a 5% interest rate conversation or a 6 or 7 interest rate conversation, it's shocking.
Yeah. I mean, we had it good for a long time, especially the last from 2020 all the way to beginning of 2022. Even though go back
it was
to
a long
February,
run.
It's been
a pretty long run.
It was a long run.
I was looking at interest rates 6 months ago, and you're thinking like 3.5%. That's Are they nuts?
Yeah, 3.5 then 4.5, then it just went straight to like 6.
Yeah, no, exactly. I mean, what I've seen from my end is that the interest rates are higher, and we don't try to ignore that fact. We try to have those conversations and figure out, is now the time right for you to buy? But also understanding what options you have, I think becomes incredibly important because I know for myself, I list a lot of property, and so does our team. And the prices on certain homes are going above ask and getting what they want.
Yes.
But a lot of the market, I mean, sellers have had the opportunity to sell their homes very quickly. And now, sellers are panicking after 20 days. They're like, my property's not under contract. What's going on? Is it even out there?
Yeah.
Right. So the advantage to buyers in that case is that the prices you're going to have better prices to go after, and you're going to have time to make decisions. I mean, in the market we were in 6 months ago, you needed to make a quick decision within an hour or 2 hours, or you lost that property.
Exactly.
And some people get very uncomfortable with it. People think like they're being pushed around, but the truth is, if you're advising somebody in the right capacity, after 1 or 2 hours, that property is gone.
Oh, yeah, absolutely.
Gone. And you're left with the dream house not being yours, right? Exactly. So I think, as you spoke about earlier in this video, that the prices are coming down due to the interest rates, and buyers are now in the position to negotiate more.
Yes.
And get the deal that they want, whereas before, you put a house under contract. If you had a contingency, that was a big deal, and then you requested the seller for something. The seller's like, I had 3 other offers.
Yeah.
See you later.
Unfortunately, they didn't have that option.
Yeah.
As a buyer 6 months ago, but now that's like you said, it's come back to a more normal market. Seller credits are back on the table. Negotiations are back on the table. But at the end of the day, it's still a competitive market. You know what I mean? We still have inventory.
I think it's still competitive because of the inventory.
100%. So I mean, again, you still want to talk to your lender before. Like I always talk to all my clients before they go see a property. I run all the different scenarios, and I'll talk to the realtor, be like, hey, you know, what do you think is realistic on this property? Do you think they'll be able to do a seller credit? Do you think we could do a 2-1 buy down? Because we want to give our clients realistic expectations and figures, so they can go into that property. If they love it, they can make that offer and make a strong offer right then and there.
Yeah.
Because at the end of the day, you're right. There's still a shortage of inventory. That's not changing.
Yeah.
So you want to be prepared. You want to be with the right people behind you, and just make sure you have all your figures lined up. So when you're looking at 3 or 4 houses, you have all your financials for each house side by side. And then you can make that
better
offer
decisions.
quickly and confidently.
Yeah, absolutely. Well, Nate, this has been incredibly impactful for me, and I think the viewers, about interest rates and what it looks like, and maybe addressing a lot of buyers' concerns. At this point, I would say if you're looking to buy any real estate in Rhode Island, all of our contact information is going to be in the description below. I'll provide mine and Nate's, and we look forward to the next time we catch you guys on video. Enjoy the rest of your day.
Thanks, Devin.